Warren Buffett is a highly respected and admired investor known for his successful long-term investment approach. His company, Berkshire Hathaway, has grown into one of the largest investment firms globally, managing around $325 billion in assets. Recently, Berkshire's quarterly 13F filings were made public, revealing their 5 biggest stock purchases. In this video, we'll discuss these notable acquisitions made by Berkshire. Let's dive right into this list. Coming in at number 5 is a recent addition to Warren Buffett's portfolio, Capital One Financial Corporation. Berkshire Hathaway purchased nearly 10 million shares of Capital One, worth over $950 million. However, it represents less than 0.3% of Berkshire's massive portfolio. Capital One is primarily known for its banking and credit card products, such as high-yield savings accounts, no-fee checking, and popular credit cards like the Quicksilver card. Despite being in a seemingly boring sector, Capital One's financials can be quite volatile, experiencing significant swings. Nevertheless, they have been consistently profitable, with $28 billion in sales and over $7 billion in net income last year. They have a solid return on assets and equity, even outperforming larger banks like Bank of America. However, there are a few reasons why I'm not personally interested in this stock. Firstly, it has declined by nearly 40% from its peak, and its forward price-to-earnings ratio remains relatively high compared to the sector. Moreover, their profits have been decreasing, missing analyst estimates for the past 4 quarters, and are expected to decline by over 30% this year. Although there may be various factors contributing to this, their profits are taking a hit. Additionally, with a dividend yield of just 2.2%, there's not much to compensate for the decline in profits. I believe there are better options available, such as larger banks like US Bancorp, which offers a substantial dividend yield above 6% and solid growth metrics. Even JP Morgan Chase, the largest bank in America, has a dividend yield closer to 3% and impressive growth metrics. Both of these options appear to be safer overall. While Capital One is not a bad stock, I believe there are more attractive alternatives, which may explain why Wall Street estimates are even lower than the current price, despite the significant drop. Moving on to the next stock, we have one that Warren Buffett has been invested in for a while and recently decided to increase his stake. It's the technology company HP. Buffett added 16 million shares to his position, bringing it to over $3.5 billion, which represents just over 1% of his portfolio. HP is well known for its computers and printers, but they are trying to focus more on higher growth markets like 3D printing and subscription-based plans for ink and paper as part of their future-ready transformation plan. However, the current macroeconomic environment is challenging, impacting HP's direct market. PC sales have declined by over a third last quarter, leading to a significant drop in total sales. Despite these challenges, there are a few reasons why I actually like this stock, especially compared to Capital One. First, HP has a solid plan to restructure its business and has the potential for success in areas like 3D printing and subscription plans, leveraging their strong brand recognition. Additionally, the stock has become cheap due to the macroeconomic situation, trading at a 50% discount compared to the sector. It also offers a dividend yield of over 3.5% and has promising growth metrics. While the business may not be growing much currently, the financials are relatively stable, supporting the dividend. We can patiently wait for the restructuring efforts to bear fruit, which could be significant. Moving on to stock number 3, we have one of Buffett's favorite holdings in the oil and gas industry, Occidental Petroleum. Buffett has been steadily increasing his position in the company each quarter, and his total stake now amounts to almost $13 billion, representing about 4% of his portfolio. However, it's important to note that Buffett owns a different class of stock than what is available to the general public. Berkshire received preferred stock and special warrants when they helped Occidental acquire Anadarko. This means that Buffett's dividend and investment structure are different from regular shareholders. Occidental Petroleum has its pros and cons. On the positive side, they generate significant financials that support dividend payments, and they have a strong presence in the US Permian Basin, which is expected to become more important given current geopolitical conflicts. On the flip side, the dividend yield is relatively low, around 1%, which is lower than the average in the sector. Additionally, while their current financials are impressive, future growth prospects appear limited. Sales are expected to decline by over 20% this year, and earnings per share may experience a substantial drop of close to 50%. Despite these factors, the stock trades at a relatively high valuation, over 40% more expensive based on the price-to-earnings ratio, compared to industry peers. So, while Occidental Petroleum is a significant player in the oil industry, it comes with some drawbacks, such as a low dividend yield and uncertain growth prospects. Moving on to the final two stocks on the list, the second largest holding in Buffett's portfolio is Bank of America. Buffett increased his stake in the bank by a little over 2% this quarter, bringing its total value to almost $30 billion, representing over 9% of his portfolio. Bank of America is not only Buffett's largest financial stock, but also the second largest holding in his entire portfolio, right after Apple. Bank of America is the second largest bank in the United States, with assets exceeding $2.5 trillion. Its size and scale provide a sense of security and stability, which is crucial during volatile times. Compared to other banks, Bank of America is better structured and managed, which may attract more customers seeking peace of mind. However, the stock has experienced a significant decline, currently down over 40% from its peak. While Bank of America is a solid choice, I believe there are better options available, such as Chase, which is larger in size, or US Bancorp, which offers a higher dividend. To assess the performance of these banks, two key metrics are often considered: return on assets and return on equity. Bank of America lags behind Capital One and Chase in terms of return on assets, and though its return on equity is closer to Capital One's, it still falls behind. Despite this, I consider Bank of America a better choice than Capital One. It offers a higher dividend yield of over 3%, while Citigroup and US Bancorp have even higher yields of over 4% and 6%, respectively, and a more attractive valuation with a forward price-to-earnings ratio of 8.3 compared to Capital One's 9. Citigroup and US Bancorp have even more appealing valuations at 7.5 and 6.8, respectively. Now we come to the final stock, which happens to be the largest purchase of the quarter. It's known other than Apple, and I have to say, it's about time we get to a stock that I'm actually a fan of. For Warren Buffett, Apple is not only his top holding, but it also represents nearly half of his entire stock portfolio, over 46% to be precise, worth over $150 billion. In this quarter, Buffett increased his stake by an additional 2%, adding over 20 million more shares, bringing his total ownership to nearly 1 billion shares of Apple. That's mind-blowing. Firstly, they have an incredibly loyal customer base thanks to their sticky ecosystem of products and services. Even though their latest virtual reality or augmented reality headset is quite expensive, priced at over $3,500, Apple's devoted fan base is likely to purchase a significant number of units. Additionally, I wouldn't be surprised if Apple releases more affordable versions of the headset in the future. This is just another example of how Apple effortlessly adds new products and services to their already sticky ecosystem. When you invest in Apple, you're not just buying their devices. You're buying into their entire ecosystem. Switching to a competitor becomes less likely when all your data and preferences are already integrated with Apple. Their massive financials, with annual sales of around $400 billion and over $100 billion in profit, along with their current assets exceeding $100 billion, give them the ability to continuously innovate and launch new products and services. This ensures that they remain competitive in the market. They also have the financial power to buy back a significant amount of their own stock, having repurchased over $500 billion worth in the past decade alone. I'm sure Warren Buffett is thrilled to see the value of his Apple shares increase over time. See you on our next one.